Good morning. I'm at Disney Springs today. I thought I'd talk a bit more about management reporting, management accounting, sometimes called Management Information Systems, MIS, or KPI, Key Performance Indicator processes. All of these things are closely related to accounting. They would have started with accounting. Of course, the most key performance indicator, typically for most organizations, is net income. How much money did you actually take away from operations and from the business? So these metrics were developed, grew out of accounting, but have kind of become their own domain itself, a little bit separate from core financial reporting, because we use them to measure the business. In some cases, the things that are needed for management reporting are separate or a little bit different than the accounting process, because we need to measure internal processes that aren't things that we report externally. And our definition of what we report is not set by a standards-making body. It's not set by accounting rules or regulated in some way. We're free to do pretty much whatever we want, whatever we think, whatever management decides will be effective for running the business. So we establish these management reporting processes in order to do that. One of the key management reporting processes is customer profitability. Customer profitability helps us understand how our customers are behaving. And there's a lot of different steps we could go through and talk about on the maturity graph for getting to customer profitability. Customers' profitability isn't something we report externally, but it's something that helps us understand how best to serve our customers, how best to match their needs, their buying patterns by providing the right kinds of service at the right price. So we'll go through a few slides here, I think, that talk about customer profitability, and you'll get a sense more of how it's related and how combining and getting to a consolidated data supply chain could provide us with much greater insight on our customers and better management reporting.
Most companies do some level of customer profitability. This graph shows level of maturity in doing more and more sophisticated types of customer profitability calculations. Most companies might start with simply their tax returns, which might be called a statutory statement, and calculating, taking how many customers they had, dividing it by the amount of money on the tax form at the bottom, and saying that's my income per customer. Another level is to then start to get more sophisticated at doing cost allocation, trying to match up the expenses particularly to a different kind of customer. Then you go more sophisticated than that, you start using account types in an MIS system. And then you can even get further along and do multidimensional analysis. Advancing organizations typically do things like data at the customer level and an integrated MIS. The last level is an integrated process or value-based MIS. There are two sides to customer profitability, a revenue and a cost side. At levels A and B, the problem tends to be both sides. Limited amounts of data are captured in the financial system, limiting the kinds of information that can be generated and the kinds of analysis that can be done. In levels C and D, the problem moves more to a revenue side of the problem, because typically as the financial systems grow in sophistication, they grow on the cost side first because we try to manage cost, and we lose visibility to the revenue side. So revenue gets aggregated highly by customers initially. Even though customers pay us directly for the revenues that we earn from them, we lose track of that information. So most organizations in levels C and D have to rework the systems to keep a lower level of detail at the revenue side. The problem then in the E and F levels is it shifts to the cost side, because now we don't accumulate cost by customers. We accumulate cost by vendors, by suppliers, by employees, by everything else except customers. And so costs are not directly attributable to customers. So matching up the cost to the revenue of the customers becomes the problems at the E and F level. G becomes both sides again, because now we're moving beyond the simple financial metrics to the things that we've talked about in terms of a consolidated data supply chain, capturing things that are not in the book of records system, not according to financial statements, but things that we know cost us money. Projections, risk attributes, other kinds of internal costs like funds transfer pricing. All of those things, when we get to this most sophisticated level of understanding how to price products and what our customers cost us, those are at level G and H. This is just one graph that a colleague of mine showed me one time that I thought was very interesting. From a sample at a particular organization, they analyzed a set of customers. They analyzed all the customers as of one point in time. They found that the top 15% of profitable customers generated 100% of the company's profit and accounted for about 40% of the transaction volumes. The next 55% of the customers increased revenue slightly above what the net income was for the organization in the end of the period, and added a little bit more transaction volumes, but not a lot. The last 30% is the key. These customers actually add 30% of the total transaction volumes, and because of those transaction volumes and the kinds of services that were being provided, they actually decreased the overall revenue of the organization, the net income of the organization, the profitability, because of those transaction volumes were servicing those customers were unprofitable. This is a nice sample, but you can't manage to a sample because tomorrow the sample changes. If you get to a true customer profitability perspective, if you can really understand customers, you can work to provide the appropriate services for those customers' needs at the appropriate cost, and not have some customers supplementing others, but provide the right service at the right cost for the customers and help customers move to the appropriate space within the graph. This is one of the key benefits that would come from having a true consolidated data supply chain. It integrates our understanding of management reporting, ties together the risk aspect of understanding customers, and has it based upon a book of records system with the full impact the book of records system has inside the organization. This is why we need a metric engine.